How about yields? Where do you see them heading, and particularly yield curve inversion? Is that going to end anytime soon?
Well, it is going to be challenging. You know, we also have to deal with monetary policy that's sort of data dependent. So our base case expectation is that the FOMC will pause in June and will stay paused until Q1 of next year. So that means that the economy will be under restrictive territory for a very extended period of time. That has to weigh in on growth. So we think as that begins to weigh in on growth, the longer end of the curve will actually will rally, in our expectation from where we are now.
We brought details of our MLive Pulse survey a little bit earlier on. Most investors are concerned about recession risk. Where does this feature in your mind?
So our base case is that of a soft landing, but the combination of the monetary policy tightening that we have seen over the last almost a year and a half, and also the tightening of the regulatory changes that are going to come to the regional banks that we think will constrain the lending coming from the regional banks. All of that we think simply raise the risk of a hard landing much higher. So our base case is still that of a soft landing, but I would say the risk of a hard landing has risen substantially, and it will get worse if we don't have this debt ceiling issue resolved quickly.
Yeah, I was going to ask you, the drainage and liquidity that we could be seeing here, it seems like when you look at stocks, you look at credit, they're really not that concerned about this. Is the market too complacent about this sort of squeeze in liquidity that we're about to see? And could it actually force the Fed in some way to reconsider QT?
It is possible, but I think there is a degree of complacency in the markets. But if you go back to 2011, when we were at similar crossroads in terms of the debt ceiling, up until the point of the X date, the markets didn't react very much. And once the resolution was accomplished, markets sold off quite a bit. And that was in part because of the nature of that resolution. So we think that it is not we should not be assuming that because markets have been relatively stable going into the X date, it doesn't necessarily mean it will follow that we won't see a correction in the market.
I see. So how are you looking at duration now, Vishy?
So I think we are warming up for duration. So at the moment we are long 5-year part of the Treasury curve. We are long 5-year part, and we think that as the year progresses, as the growth, the slowing of the growth, whether or not we go into an explicit recession, we will expect to see growth slow from the pace of growth that we saw last year. And as those growth growth slows, we expect to see the longer end of the curve rally. At the moment, we think that really means long 5-year treasuries, long steepeners in the curve, and that's where we are most focused on. But I think we are warming up to duration as we go along.